Saludamos a Edward Moya, Senior Market Analyst de Oanda. Edward, hello. Good morning for you.
Thank you for having me.
The US job report for March is coming up on Friday, and of course, it will be closely watched. What can we expect?
Well, the non-farm payroll report is supposed to show that the labor market remains strong. I think there's expectations that you're going to continue to see strong hiring. The labor market is still fairly robust, and there's still plenty of jobs available. So there's expectations that we'll probably see around 400 to 500,000 jobs created in the month of March. And there's expectations that you're going to see wage pressures remain, and the unemployment rate should tick lower.
The Fed's preferred inflation gauge rose 5.4% in March. We have seen it today. Is this the highest since 1983? Could this data confirm 50 basis points hike in May?
It pretty much seals the deal for that. I think there's a complete expectation now that the Fed is poised to deliver a 50 basis point increase in May, and also another 50 at the next meeting. I think the Fed is playing catch up here in fighting inflation. They've been slow to react with all the inflation that we've seen since the end of last year, and you're probably going to see this aggressive pace for the next few meetings, and the Fed will become much more concerned as the geopolitical risks will likely keep pricing pressures going strong for the next few months.
Let's go to the market. And now that we are ending the first quarter of the year, what can we expect from upcoming earnings? Could we expect more profit warnings due to the war uncertainty?
Well, I think what we're expecting, supply chain issues are really going to become the focal point. I think that the consumer is starting to show some weakness. I think we have to remind ourselves, though, that right now, both corporations and households still have good balance sheets. So, I think you should not anticipate a complete deterioration in spending and investment, but these price increases are going to start to weigh on investment. But I think you're going to see softer earnings, and I think you're going to see the guidance is going to be a little bit weaker. And I think a lot of companies are going to withhold providing much more outlooks because the geopolitical picture it's a big question mark, and that's really going to impact commodity prices, which could have violent swings in either direction. So I think investors should anticipate a lot of hesitancy in committing to strong guidance for the rest of the year, but I think overall the consumer is still strong, but I think there's expectations you're going to start to see more weakness as we go deeper into the year.
Taking all this scenario into account, which investment opportunities do you see at this market?
Well, right now, I think equities are still looking pretty good. For the S&P 500, we're only down roughly 5% from record highs. I think that mega cap tech stocks, a lot of the favorite ones like the Apples, Microsofts, and Googles, they've actually done pretty well recently, and I think that outperformance might lead to a little bit more of a consolidation here. So there's probably going to be expectations that you might see much more of a sideways market. So you might see investors turn defensive. So consumer staples might do well. I think energy stocks are still going to be the go-to trade. Energy companies are going to do very well as energy prices are going to remain elevated for the rest of this year, next year, and probably the year after. I think there's been a lack of investment in new wells, and you're probably going to see that the oil market is likely to see higher prices in the short term, even as you're going to see coordinated efforts to tap strategic petroleum reserves over the next several months. But I still think that you're going to see these oil companies, they're going to be profitable with oil at $70, and right now we're probably looking at oil remaining around the $100 for quite some time. So oil, energy stocks are going to do well. Financials will probably benefit from rising interest rates. I think that a lot of these, when you take a look at how bank lending is done, that curve is actually steepening. I know a lot of the focus is on inversions and the flattening of the curve, but bank lending is actually going to do pretty well, and the economy is still going to, I think, support that. So I think you'll probably see commercial banks will probably outperform. So I think there are some opportunities, but I think overall these next few months will be sideways for equities.
This is the Markets Vision from Oanda. Edward Moya, thank you so much for attending us. Have a nice day.
Thank you.